Good morning, everyone. Welcome to Daily Rates Live with the Mortgage Calculator. Today, we're going to talk about our actual live mortgage rates, and then we're going to do a deep dive into asset utilization loans. Great topic here today. Just give us a second to go live on all the different platforms. We do appreciate everybody tuning in nice and early. And it looks like we are live. So we'll go ahead and get it started here. Go ahead and keep dropping comments there in the chat. You can drop any questions you have in the chat as well as we talk about our topic for today. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey. We are a lender that specializes in non QM loans. And what we do every morning on this show at 11 a.m. Eastern is pull up our actual live mortgage rates for some different programs. And then we do a deep dive into a different loan type. And today's loan type is going to be asset utilization loans because we specialize in non QM loans here at the Mortgage Calculator. It's definitely something we're very familiar with. So, let's go ahead and get into it. Nick, if you're ready, let's go ahead and pull up our rates and see what it's looking like this
All righty. So before I pull this up, we were going to check out all of our different programs here for today, June 27th, just after 11 a.m. Eastern. So all of our standard programs are live. We'll set up a basic scenario so we can compare the APR across the programs. If you'd like a full breakdown of all numbers, we have over 300 loan officers to help you out. For our scenario here, we will set up a standard single family home. We'll do a 500,000 purchase price, 400,000 loan amount. That corresponds to 80% loan to value, 20% down payment. And we'll set an estimated 760 credit score for all the demos and an estimated 40% debt to income ratio here for all the demos. So let me go ahead and share my screen and we'll be able to compare all the different programs we have here. We'll make it big. All right. So first option for most customers thinking of a standard mortgage is a conventional 30-year fix. So 30-year fix conventional for a primary home comes in today at 6.624% rate. Final APR 6.940, just a touch higher than it was yesterday. The markets did go up a touch. Now, if for any reason our customer doesn't qualify for conventional, typically the next option we want to present is an FHA option. FHA allows more leniency on credit issues as well as a higher debt to income ratio overall. However, it does have upfront and yearly mortgage insurance that is required. Today, FHA rates come in as low as 5.75, final APR 6.711. So notice if our customer qualifies for both, they may want to check out FHA because the APR is slightly lower when you compare side by side, but it does require that mortgage insurance. Next program we have here is our VA program. That's only for our eligible vets and active service members. If you are eligible for a VA loan, these programs are pretty amazing. Rates as low as 5.875, final APR 6.195. So notice if our customer is qualified for VA, definitely beats FHA and conventional by a long shot here. So a great program for our veterans. And the final option here for agency government standard programs is a USDA option. So USDA is only for properties in a USDA eligible area, typically rural areas of the country. So if our borrower and our property is eligible for a USDA loan, rates come in at 5.75%, final APR 6.5. So notice if our customers typically going to compare a USDA option to an FHA option or a conventional option. And as you can see here, USDA is a little bit cheaper. So if our customers are looking in those areas and qualify for these programs, definitely a great option. Now, those four standard options are the options every bank and lender typically has. And if our customer doesn't qualify, many other banks or lenders have to deny them. That's where we love to present our 5,000 other options, starting here with our 30-year fixed non-QM alt doc program for a primary home. So if our borrower doesn't qualify for a conventional or FHA or anything else, we can offer them a alt doc option using docs such as bank statements, P&L programs, 1099 programs, and today's topic, asset utilization programs. This lowest rate option here is probably a bank statement or similar. Rates come in today 6.99%, final APR 7.309. So notice we're within a half a point of conventional. So our customers that can't quite qualify for a standard option for very minimal additional costs can use alternative docs. So a great option here. And moving along to our investment options. Investment properties offer a lot of flexibility. So first option here for an investment is our non-QM alt doc. Again, bank statement or similar, most likely here for the lowest rate option, 7.375, final APR 7.7. And we'll compare that to our other investment property options. So there are no government programs, so no FHA, VA, or USDA for investments, but we do have our conventional agency option here for investment properties coming in at 7.375 rate, final APR 7.740. So notice it's a touch higher than AltDoc today. You see these flip-flop sometimes. But I definitely recommend all of our investors check out our favorite program, our DSCR option. So DSCR stands for debt service coverage ratio. No income needed, no employment needed. We simply use the estimated rental income from the investment property to determine a DSCR value. If the estimated rents can cover the expenses, aka the property will cash flow, that's a ratio of 1 or more. For all the demos here, we use a ratio of 1.5 so we can see all the programs. First up here is our 3-year prepayment penalty option, which is standard. Rates come in at 7% today, final APR 7.342. So notice that beats conventional, absolutely amazing. And some programs do allow a 5-year prepayment penalty, and the rates get even lower. Rates as low as 6.75, final APR 7.072, which beats conventional by a long shot here. And the final option, some states and some investors don't want a prepayment penalty. No problem. We do have those options. DSCR with no prepayment comes in at 7.5 rate, final APR 8.008. So notice that's a touch higher than conventional, but most investors prefer DSCR loans anyway, and it's very comparable here. But if our investor is open to it, definitely recommend to use the prepayment penalty to sweeten the rate there. And the final two options here, very popular requests these days, as many of our customers have a low rate first mortgage in the last few years and want to get some cash out but don't want to touch that first mortgage. So we have our 30-year fixed second mortgage options, which is not a HELOC and not variable rate, so definitely borrowers out there. So get cash out of a primary without touching the first mortgage, rates as low as 8.75, final APR 9.189. And this is a non-QM program, so we can even use bank statements and similar. And same thing, a 30-year fixed second mortgage, but for an investment property. Our investors can get cash out without touching the first mortgage. Rates as low as 9.875, final APR 10.185 here to get cash out of an investment property. And again, this is a non-QM option, so can use bank statements or similar. Let me go ahead and switch my screen here. And since Jose is gone, it's going to take me a minute to get set up here, but he did send me some asset utilization options to go over. So let me switch my screen here in the other tab real quick. And we will check out these demos that he has sent us. Share the other window here. And we'll make it nice and big. All right. So asset utilization loans are a non-QM program that we love. Again, another tool in our tool belt that allow us to use a large asset account. Typically for conventional options, we can use asset utilization, but they do have a lot of limitations, age of the borrower, things like that. Whereas here in the non-QM world, which we're presenting here, these are standard asset utilization programs. So any asset account, typically over a minimum amount, maybe 500,000, or typically over the loan amount plus the cost of reserves, can be used for asset utilization. Every program has a different factor. Some divide that amount of assets that we can use. So say we have a $1 million retirement account, we can divide that by 20 for some investors, 60 for some investors. It all depends. So whatever factor we get, we can use those large accounts, typically retirements or similar, and then divide them by some sort of factor after we reduce it for non-liquid accounts, right? Retirements aren't liquid, so sometimes there's a haircut to those and other factors. But once we get to the final amount of assets we can utilize for the loan, then we apply the factor and divide it by a certain amount, and that gives us a monthly income amount we can use. So very easy program, doesn't require any income or employment either. Definitely a very unique option. So first option Jose presented us here was our lowest down payment option. So asset utilization, non-QM for a primary purchase. We can do as low as 10% down, 90% LTV. And remember, there is no mortgage insurance required for non-QM loans. So that's all included in here. So let's scroll down here, check out the options. So the lowest cost option here, 9.5 rate for a cost of 0.5. And the lowest rate option, 8.375 rate, costing 2.4. So this is, again, our standard scenario that we use for our demo, 500,000 purchase price. And in this case, 10% down would be a $50,000 down payment, $450,000 loan amount. So a great option for our borrowers that need to use a non-QM option, don't qualify for conventional perhaps, and have a large asset account. Now we'll move on to a more standard 15% down, which does sweeten the rates quite a bit. 10% down is obviously the max leverage. So let's check out our asset utilization for primary with 15% down. So you see here the rate of 8.624 gets us no cost, a par rate. And we can even buy that down to 7.499 for a cost of 2.4. So definitely got better than our last example there. And again, this is a 500,000 purchase and 15% down is 75,000. And Jose's presented an option here for investment properties. So we can use the same program, asset utilization, whatever assets are available, divided by a factor. And we can use that for an investment property. Here's 15% down option. Almost the same as primary here. 9.249, sorry, rate is a par rate, no cost. And we can buy that down to 7.499 for a cost of 3.4 here for an investment property. And again, that was a 500,000 purchase with 15% down, which is a pretty sweet deal. And now we'll move on to the more standard 20% down for an investment property, which gets us to the more standard rates we love to see here. So for an investment property, 20% down is pretty standard, but using asset utilization is a very cool way to do it. So with this program here, 8.25 rate gets us a par rate, no cost. And we can buy that down to 6.875 for 3.275 points. So we can get the rates pretty low there using assets only. And again, this is a 500,000 purchase, 20% down would be 100,000 down for 400,000 loan amount. And now Jose presented us some options for lower credit score. So obviously all our demos are based on a high credit score, 760. Here we'll show the lowest option. So we can go down to a 600 credit score and still use these programs. But we do have to put more down. So we have a 25% down option here with a 600 credit score. So we'll pop open the points here. And 11.375 rate is a par rate here, no cost. And we can buy it down to 10.25 rate for a cost of 2.275. And again, that's a 500,000 purchase. Because it's a low credit, 600 credit, we can go down to 25% down, which is 125,000 down, and get a 375,000 loan amount using assets only. No income employment information needed, which is pretty cool. And for our investors, we do have options to use this program for as low as 25% down with a 600 credit score. So great option here. It's actually even better than the primary. And we see here we have options 11.499 is a par rate for no cost. We can buy that down to 9.875 for a cost of 3.275 points here. And again, this was an investment property, 500,000 purchase, 25% down. And that gets us a 375,000 loan amount. And the final option Jose presented us here was a cash out option. So we can use asset utilization for a cash out. And for an investment property, we can even get up to 80% loan to value cash out with, of course, the higher credit score of 760 that we use for our demos here. So to get a cash out with no employment or income needed of an investment property using assets only, 8.874 rate is our par rate. And we can buy that down to 7.249 or 3.4 cost there. Again, this was a $500,000 value and cash out up to 400,000. So absolutely amazing. Assets only. Very cool way to use our non-QM programs. So let me switch it back here.
Okay.
And let's see if we got any questions.
Yeah, we do have one question here, but I think you pretty much already answered it throughout the course, but do you want to go over it one more time, Nick, of some acceptable asset examples?
Okay, I see it here from Michael. Yes. It all depends on the investor in the program, right? Every loan program is different, and every program is going to treat the assets differently. But any assets are typically usable. Anything that has some kind of encumbrance, such as typically retirement accounts, right? If you're not retirement age and there is some sort of penalty to withdraw, they're going to obviously take that penalty or just apply a general 25% haircut is often standard to a non-liquid account. Any liquid accounts can obviously be used, cash, stocks, things like that that can be liquid are typically valued at 100% of the value because they're liquid. Anything that's non-liquid and encumbered in some way, we typically can use, but we do have to factor in that encumbrance, typically with a haircut value. So just check out the guidelines. It is a little tricky. That's why we don't always present it in the live rates, asset utilization. Every program just has those slight variations on even the factor we can divide, the haircut we have to apply, the types of accounts that can be used. But we do have hundreds of options. So whatever our borrower needs, we likely have the solution. We just need to dig through and find the exact program that fits for the exact type of assets. Another question popped up here. Do you deduct liabilities? Often, yes. Again, every program is different, so you have to look at the equation. Many times, the most common way that these loans are set up is the assets that we're going to use. So say we have $1 million in retirement that we want to use. They're going to deduct typically the full loan amount. So say we want to buy a $500,000 home, right? $400,000 loan amount. They're going to have to take that 400,000 out. They're going to have to take out reserves, right? And then apply all of the math, right? So not necessarily liabilities that we would deduct technically there, Natalie, but typically we would deduct the loan amount plus the reserves that are required for the loan. So say $500,000 is needed for the loan amount plus reserves, and we had $1 million in retirement. That means the additional 500,000 above the loan amount and reserves are what we factor in. So if it was a retirement account and the program said 75%, we would take a 75% value of that 500,000. Then we would apply the utilization factor. Oftentimes, 60 months is used there. So 500,000 times 0.75 divided by 60 would be our monthly income we can use. So not often we're deducting liabilities. Most often we're deducting the full loan amount plus reserves to get our usable assets that we then apply the math to. Hopefully that helps.
All right. I don't see any more questions, so I think we can go ahead and wrap it up here. Remember, we do this at 11 a.m. Eastern every weekday where we go through our live rates and then do a deep dive into a different loan type. So we'll be right back here tomorrow with a new loan type. Appreciate everybody tuning in. We'll see you tomorrow, 11 a.m. Eastern, for the next episode.